Hello people, very good to all of you. So guys, we are beginning with a brand new topic today, which is account current. Guys, let's quickly have a look at from the examination point of view. This particular chapter have been asked for how many marks so far. So like guys, if you look at this, account current was asked in May 2018 attempt for 5 marks. Again in November 18, it was asked for 5 marks. In May 19, it was not asked. There was no question from account current, but from November 19 onwards, from November 19 till December 21, in every attempt, there was a question from this chapter for 5 marks. Look at this, May 2018. May 2018, here you can see account current, 5 marks. November 2018, account current, 5 marks. It was an internal choice. It was an internal choice between account current and sale of goods on return or approval basis. In May 19, guys, in May 19, it was not asked because May 19 was an attempt where 3 chapters was, asked for the very last time. The question from these 3 chapters was asked for the last time. So they gave importance to those 3 chapters, which was joint venture, royalty accounting, and then your ratio analysis. So this was the final attempt for these 3 chapters. So they focused on these 3 chapters and they did not focus on the account current. So May 19 ke baad, if you look at, look at November 19 attempt, guys. Again, this account current was asked for 5 marks. In November 2020, account current for again 5 marks. Jan 21, account current was independently asked for 5 marks. July 2021, guys, account current for 5 marks. December 21, account current was asked as a internal choice again for 5 marks. Except one attempt, we had in all the attempts one question coming from account current for 5 marks, right? So if you observe, guys, if you compare these 3 chapters, that is average due date, account current, and sale of goods on return or approval basis, put together have been asked for totally 10 marks. One question will be independent and the remaining 2 will be internal choice. So for example, average due date, sometimes they'll give us a separate question and they'll give these 2 questions as an internal choice. Or they may give account current as a independent question and average due date and sale of goods will be internal choice. So both or all the 3 rather put together, I would say it has come for 10 marks. So we have covered average due date so far. We have covered up the average due date so far. Account current will be targeting now. And after this, we'll be doing this chapter. So all these 3 chapters put together should cover up 10 marks for your CA Foundation examination. Now coming back to the account current, guys. Account current is a chapter, I would say, which is an extension of your ledger chapter. Right? So what I'm trying to say, you'll understand in next couple of minutes. Let's take an example, guys. So this is Mr. X, businessman. So we are doing accounting from Mr. X point of view. So Mr. X is selling goods on credit to Mr. Y. Mr. X is a businessman who's selling goods on credit to Mr. Y. He's not only selling the goods, guys, he's also buying the goods from Mr. Y. So purchasing goods on credit. Both are happening together. Mr. X is selling goods on credit to Mr. Y and he's also purchasing goods on credit from Mr. Y. Now guys, like this, there are numerous transactions of purchase and sale that is taking place between Mr. X and Mr. Y on credit basis. So can I say one common account that you prepare from the business point of view will be, can I say Y's account? can I say prepare one single common account called as Y account. So this is Y's account. Date, particulars, rupees. Date, particulars, rupees. Now, when we are selling goods to buy on credit, what would be the journal entry? Data to sales, and data here is Y. So Y account debit to sales. So in Y account, can I say to sales? Online people, can I say that Y account debit to sales? Please tell me yes or no.
Yes, sir.
Yes, sir.
Yes, sir.
Like that every time you do a credit sale, can I say this will be the transaction that will get repeated again and again? And now if we are purchasing from Y, it is a credit purchase. We are buying from Y. So purchase account debit to Mr. Y. So can I say buy purchase? So buy purchase. Buy purchase. Every time I make a payment, sorry, I make a purchase, I have to pass this purchase entry. Clear with this point? Now what happens is that for every credit period transaction, guys, there is a due date agreed on which you are supposed to make the payment. Correct? So if let's suppose this is the date of transaction. This is the date of transaction and the credit period is, let's suppose, 1 month. Today is 30th of June 2022. The credit period is given for 1 month. Date of transaction is, you can take either purchase or sale. Maybe we can take it as a purchase transaction. Let's suppose this is credit purchase. Credit purchase has taken place on 30th of June, and let's suppose that two months of credit period. So can I say 2 months will get over on 31st of August 2022? This will be the due date upon which you are supposed to make the payment. So from this period to this period, we are enjoying the credit. So can I say this is the credit period? In this period, we do not have to make any payment. There is no need for us to make the payment. We have an option to make the payment. We have an option. If you want, we can make an early payment, but not required. Due date is sufficient. Now here what happens is that if let's suppose you don't make the payment on due date, you make the payment after due date. Let's suppose here on 30th of September 2022. So can I say there is a delay of 1 month? Can I say there's a delay of 1 month?
Yes.
On 30th of September, if you just pay the credit purchase value and come off, will Mr. Y accept? Mr. Y will tell that, my dear friend Mr. X, the original due date that was agreed for payment was 31st of August. Had you made the payment on 31st of August, I would have taken the purchase value and I would have been quiet. But you broke that promise and you made the payment on 30th of September. You've delayed the payment for 1 month. So can I say for a delay in payment, there is a compensation that we have to pay to Mr. Y. That is, Mr. X has to pay one compensation to Mr. Y, and that is called as interest. Yes or no? We have agreed to this concept. We've discussed this concept already. So if any person is making payment delayed, that is on due date, if he's not making the payment, or if he's making a delayed payment after the due date, he has to pay, along with the transaction value, he has to pay the interest component. Why? Because Mr. Y will say that, had you made the payment on 31st of August, had you made the payment on the due date, I would have invested this money in my business and would have earned more money. So because of you delaying the payment, I lost that opportunity of investing that money into my business. Therefore, the earning opportunity is lost. So you have to compensate me by paying interest. Interest to be paid. So by paying the interest, you have to compensate me for that loss. Is Mr. Y genuine in his demand? Nothing wrong? Right? No? Okay. In same way, if Mr. X makes early payment. Let's suppose on 31st of July 2002 itself, he makes the payment. This is the date of payment. So can I say this is early payment? Just like if you're making a delayed payment, you're supposed to pay interest. Just like in delay of payment, you're supposed to pay interest. For early payment, there is an option to receive interest. In other words, we can say we'll receive the discount, cash discount. Cash discount is a concept that we studied in the 11th standard, where to prompt somebody to make the early payment, right? We tell them we'll offer you cash discount. So early payment means we have an option to receive a cash discount, which is, you can say, rebate received. We have studied in the concept of bills of exchange. Rebate received for early payment, discount received. So here we will receive interest. Interest to be received. So can I say in a credit transaction, there are three possibilities. One possibility is that on due date you make the payment. In such a case, no interest will come. Neither I will pay nor I receive. If I make a delayed payment, then I have to pay interest. So pay interest in case of a delayed payment. Third option is if I make an early payment, then I have to receive interest. So just imagine, in a year, you are having hundreds and thousands of sale transactions. You have hundreds and thousands of purchase transactions. Some transaction you are making on the due date payment. For some transaction, you're making the payment early. For some transaction, you're making the payment delayed. So let's suppose this I'm making the payment on time. So this is delayed payment, timely payment, early payment, delayed payment. Three options. Timely I paid, lately I paid, that is delayed payment, and early payment. Now same thing can happen with sale also. We have given the goods on credit to Mr. Y. So Mr. Y has to make the payment. By doing the credit sale, I will receive the payment. So I am receiving the payment, let's suppose on time, I'm receiving the timely payment. This is called as timely receipt. Timely receipt. So I've received the money on time, which means on due date I've received it. Or Mr. Y, he can also make the delayed payment. No? So in that case, can I say delayed payment? We will receive the interest in case of delayed payment because Mr. Y is delayed the payment. So he has to pay interest to whom? To us. So we will receive interest. And sometimes Mr. Y will make early payment, earlier than the due date. So for early payment, we have to give him interest because he's made the payment early. So we have to reward him with a cash discount. Again, let's suppose delayed payment. So for every transaction, imagine you have to sit and calculate what is the delay, what is the early payment, what is the interest receivable, what is the interest payable. Calculation is not a problem. The problem is this is Y's ledger, which will capture the data of sale and purchase, which will capture the data of payment received and payment made. But interest received, interest paid will be captured in different ledger. So now what will happen? Let's suppose there is a delay in interest. Let's suppose there is a delay in interest. Sorry, let's suppose there is a delay in payment. We are making the delayed payment. So we have to pay interest or receive interest? Pay interest. So can I say this interest expense for us? Correct, no? So we have made the delay of payment. We did not pay on due date. We paid 1 month after the due date. So we have to pay interest. What will be the journal entry for that? Interest expense account debit, because it is expense for us. We have to pay interest expense for us to Y. Correct? So in the interest account, can I say 2Y? 2Y how much? How much? Whatever is the amount. 100 rupees is the interest. Whatever it is. 100 rupees is the amount. Now, let's suppose we have made the early payment. So we will receive the interest. So can I say separate account? There will be separate account called interest received or interest receivable account. So what will be the entry? Y account debit to interest received. So by Y. Now for each and every transaction, guys, you have to sit and identify which transaction is paid on time, which transaction is paid delayed, which transaction is made early payment. So if you have all the information in 3 different ledgers scattered, don't you think it is a burdensome activity to do, especially when you are aware that there are hundreds and thousands of transactions happening like this? So boss, here 100 I've put it. In reality, you have to calculate. So first of all, you have to identify which transaction has been paid, on what date. So transaction date, calculate the due date. It's a big task. So having all this information in separate ledger, it'll be a big task. Sometimes here what people do is they don't put Y account. They put interest expense to interest expense payable account. They don't create liability in the Y account. What they sometimes they do interest payable account. So they create a liability account separately. And instead of putting Y's account, what they do here is interest receivable account. Because they take it to the common ledger. How much is interest receivable payable? They take it to common ledger. Now, if they have a common ledger like this, some people do this way also accounting. Nobody can stop. No? So here, if I want to know how much in net I have to receive from Y or how much in net I have to pay to Y, calculating everything will become very difficult because this ledger can have both debit and credit balance. This ledger can have debit balance and this ledger will have credit balance. In such a case, having 3 separate ledger, then saying what is debit balance, what is credit balance, combining, and then telling the opposite person, boss, you have to pay me so much. Then again, I will have to tell that I have to pay you so much. So it is all very confusing and creating a havoc. So what expert suggested is that this ledger which has got 3 columns, what we would do is we would extend this ledger by adding 3 more columns and combine all the transaction of purchase, sale, interest, receivable, interest payable, everything in one ledger in such a way that one single ledger will give you complete information. That is how the concept of account current was created. So if you look at the format of account current, it is I told you, account current is extension of ledger. So in ledger, you have how many columns? 3 columns, date, particular, rupees. I will add 3 more columns. This is date. Transaction date is date. Transaction date is date. Particulars, amount in rupees. Correct? Then I told you I'll add 3 columns. Column number 1, due date. So with the transaction, if I calculate the due date, I can compare these both and calculate how many days of early payment, how many days of delayed payment. So I'll get the days of early payment, days of delayed payment. And on that, I'll calculate the interest receivable. On the credit side, guys, date, particulars, amount, like we have here. Date, particulars, amount. 3 columns are common. Additional 3 columns. Due date, number of days, interest payable. Interest receivable. What is the nature? Asset, liability, income, or expense. Interest receivable. If I say interest expense, it is expense. Interest paid is an expense. Interest received is income. This is interest receivable, which means receivable means I'm yet to receive. Yet to receive means I'll receive in future. Anything that I receive in future is asset. Asset is got what balance? Nature. Debit balance. So can I say on the debit side I've recorded interest receivable? Any problem here? Interest payable means yet to pay, which means I'll pay in future. Anything that I pay in future is liability. So liability has got what balance? Credit balance. So it will come on the credit side. So this complete set of account or statement will give you a total picture. How much is the interest to be collected? How much interest is to be paid? What is the final net amount? Who should pay whom? Everything will come under one statement. That is how the birth of account current has happened. Are you able to understand what is happening? Here, are you able to feel the pain? There are 3 different ledgers I have to toggle between. I have to juggle between 3 different ledgers. There is no due date column. So I have to do the interest calculation separately. So apart from these 3 ledgers, I have to have a separate working notes for interest receivable, interest payable. It's a big headache. Now here, everything is coming under one roof for me. Everything is coming under one roof for me. Isn't it easy to do it? Are you able to understand? Online people, please respond.
Yes, sir.
Yes, sir.
Sir. Yes, sir.
Everybody. So an account current is a running statement of transaction between parties for a given period of time. This statement is for a given period. Any statement for that matter is for a given period. Now, trading and P&L is for a given period, April to March. Balance sheet is a given period, April to March. So like this statement is also for a given period and includes interest allowed or charged on various items. It takes a form of a ledger account. It takes a form of ledger account. So I'll not read too much of theory and bore you. I'll straight away take you to the question. Some of the situation, I'll just take this example. Some of the situation when account current is prepared, like which all situation this is apt. One situation we discussed in case of credit purchase and credit sale between the buyer and the seller. Seller here is not the end customer. You can say here it is the manufacturer versus wholesaler or wholesaler versus retailer. The transaction is frequently happening between these people. Apart from that, we will be studying one topic called as consignment. So this happens between consignor and consignee. Who is consignor, who is consignee, you'll understand the consignment topic. So this statement is helpful for those people also. Account current is helpful between the banker and the customer because between the banker and customer there's frequent transaction. The account current is also frequently prepared to set out transaction taking place between banker and his customer. So banker is giving loan to the customer. Customer is giving fixed deposit to the bank. So there's few frequent transaction happening. So in that case also this account current statement is actually coming handy. And this is also between, it is prepared when two or more persons are in joint venture and each co-venture is entitled to interest on their investment. So this is a joint venture agreement. A joint venture is a business form where two or three people come together, to do a business. So here upon their investment, I made this investment in the business, you have made this much investment in the business, and both of them will exchange interest with each other. In that case, this account current is handy. So these are the four situations, just example they've given where account current is coming into picture. So you can keep in mind, whenever there is a transaction coming into picture between two people, where I have to give money to somebody, they have to give money to me, and this involves interest on delayed or early payment. In such case, account current statement is going to be helpful and handy. Am I clear with this point? So let's take one example, guys. Illustration 1 of your ICA study material. Here it says that prepare account current for Nath Brothers in respect of the following transactions with Sham. Prepare account current for. Prepare this statement for Nath Brothers. So who is the businessman here and who is the party here? If you can tell me. Nath Brothers is the businessman because we are preparing the account current for the business person for doing the transaction with Sham. So transaction with Sham is a party. So in the books of, please don't write that. Wait. I'll tell you why. So we are going to prepare this statement in the books of Nath Brothers and Sham is the party. Now here you have a different way of writing the heading. Look at this language. Sham in account current with Nath Brothers. This is how you will present it. So Sham is the party. So party's account current. This account current statement what you are preparing is prepared in the party's name. So Sham in account current with Nath Brothers. So the first person, guys, first person Sham is the party. And the second person, Nath Brothers, is the person in whose books, for whom you are preparing the account current. This is the style that you have to adopt here. Sham is the party. Party's current account current with Nath Brothers. So Nath Brothers, the second person here is the business in whose books we are preparing this statement. Party books. Normally, how do we prepare? If I write the heading, we record in the books of. In the books of Nath Brothers, we prepare the party account, which is Sham account. So first we have book person's name and Sham's account. Here the name will change. First the party's name will come. So party's account current with the businessman. Are you able to follow? This will not make the mistake. It will be ulta. The name will be ulta. Order will be ulta. Now, what is the format, guys? Before that, one more statement you have to write. This statement is up to a particular date. If you look at the question, guys, at the end they would have said that the account is to be prepared up to 1st February. The transaction is starting from September 16. From September 16 up to 1st February, the statement is the period for that period of range. So this statement is up to prepared up to 1st February, having interest at 6% per annum in case of delayed payment or early payment. Okay. So interest up to 1st February 2020 at 6% per annum. The heading has to be standard, guys. You cannot change it. This you have to keep in remembrance. Now, if you look at the format, guys, this is also a T-shaped format. On the left-hand side, you have 6 columns. In that 3 column will be copied as it is from your ledger, which is nothing but date, particulars, and amount. Date, particulars, and amount, which is coming from the ledger. Date here means transaction date. Now, the question that will come into your mind is, sir, too many columns, right? How do we incorporate all that in one single page? So can we turn the page horizontal and do it? No, my dear friends, you're not allowed to do it. So what you will do is, when you're doing this kind of questions in your exam, you will take this question in a fresh page, where the left hand, that is this part of the ledger, you'll be doing on the left side of the page, and the right side of the ledger will be doing on the adjoining page. So you'll be doing 2 pages. No, margin you're not supposed to use. Margin is only meant to write the question number. It will be broad, but still being broad, you will not be able to incorporate all the column in one single page. So you have the liberty to use both the pages adjoiningly. Like if this is your paper, this will be your paper, na? So this is your paper. Let's say page number 1, page number 2. So left hand side of the ledger will be written here. The columns you'll draw it here, and the right hand side of the ledger you'll draw it here. Are you able to follow? You can use the pages simultaneously. So please note down this format, guys. Please note down this format. Transaction date. Date means transaction date, particulars, amount. In addition to that, you'll have to add 3 more columns, which is due date, days, interest receivable. Interest receivable ke niche you have to write that interest receivable or interest payable receivable. What is this? I'll explain. What is this? I'll explain. Just copy down this format. Guys, please note down this format and give me a heads up. We'll go forward. Please note down this format. On the left hand side of the page, you will put 6 columns. On the right hand side of the page, you'll put the 6 columns. You can write date, transaction date, anything is fine. Date here means transaction date. So even if you write date, nothing to worry. Online people, are able to follow what I'm discussing?
Yes, sir.
Everybody?
Yes, sir.
Yes, sir.
Yes, people. So first transaction, guys, this is happening in the year 2019. So 2019. On September 16, guys, goods sold to Sham for 200 rupees, guys. Goods sold to Sham for 200. Please tell me, if it is a credit sale transaction, what is supposed to be your journal entry? What is a journal entry for credit sales? Data to sales, and for us data here is Sham. So Sham account debit to sales. So can I say this is Sham's ledger? Yes. This is Sham's ledger. So Sham account debit to sales. So can I say in Sham accounts ledger to sales? To sales. The sale is happening on September 16th. On September 16th, to sale in the amount column 200 rupees, guys. In the amount column 200 rupees. Me. You will understand why I'm not writing it. No, I can write it, but I wanted to show the days calculation, to be precisely, presented. So I'm just doing it this. So September 16, guys, 2 sales, 200 rupees. Now, guys, this method of calculating the account current, now, it is called as forward method. So there are basically 4 methods of preparing the account current. In that, one is forward method, having 2 sub classifications. In that, interest method and product method. So today we are going to learn forward method, under that interest method, right? So what is forward method? You will travel forward. When you calculate the number of days, you will travel forward from the transaction date up to the statement date. What is the statement date? The statement date is 1st Feb. So I'll be traveling from September 16 to 1st Feb. Okay. So how do we do that? Before that, if you see, there is something called as due 1st October. This is nothing but due date. The goods have been sold on September 16. That is the transaction date. And Sham is supposed to make the payment on 1st of October. So due date here represents the date of making the payment. So in the due date column, please write 1st October. Any problem till this? Don't do it. So what is the transaction date? 16th September. What is the due date? 1 October. And what is the account current statement date? Account current statement date is 1st of Feb. Clear with this point? Now, on the transaction date, the sale of goods has taken place. So on this date, you're supposed to make the payment. Now, always remember, for all purchase and sale transaction, from the due date, you will presume that that person will not make the payment. When you prepare the statement, you will keep what assumption in mind? The assumption will be that on the due date, this fellow is not making the payment. And he's not making the payment till 1st of Feb. So if he's not making the payment till 1st of Feb, so can I say for this period to this period, we need to calculate interest. Correct? So please tell me from 1st October to 1st of Feb, how many days have gone by? So October totally 31 days. 31 days minus 1 day of October. Because on day 1 of October, you're supposed to make the payment. So October 2 onwards, the interest will be started calculating. So in October has got 31 days, guys. From 31, if I minus the 1st day of October, I'll be left with 30 days of October plus 30 days of November plus 31 days of December plus 31 day of January plus 1 day of February. So 123 days delayed payment is happening. So we're presuming that after 1st Feb, the payment is done. If that is the assumption, then the delayed number of days is 123 days. Any problem here? From 1 October, that is from due date to the statement date, you're supposed to calculate how many days there have been delayed payment under the presumption that the amount is not paid. 1st Feb is the account current statement date. No? The statement is prepared up to 1st Feb. The statement is prepared up to 1st Feb. So for example, tell me one thing. The financial year ending happens when 31st of March. So when you do the adjustment entries for prepaid, accrued, all that, what is the cutoff date you take? The cutoff date is 31st of March, right? So same way here, the cutoff date is 1st February. Here the cutoff date is 1st February. So the statement date is 1st February. No, I'll come to that. No, I'll come to that. Now the presumption is there is a delayed payment of 123 days. For this, I need to calculate interest. So what will be the interest? 200 is the amount. 200 is the transaction amount. Into 6 by 100. Into 6 by 100 is what? Interest for the entire year. But have we delayed the payment? Or has the Sham delayed the payment for entire year? No. It's delayed for 123 days. 123 divided by 365. Now here, the question has clearly told you that 1 year is equal to 365. Why? Because 2020, guys, in 2020, February is a leap year. So you might think that being a leap year, I should take 365 days. So question is very clearly told that nothing doing, 1 year equal to 365. Take this into consideration and do the calculation of interest. So 200 into 6 by 100 into 123 divided by 365. So 200 into 6 percentage into 123 divide 365. 4.04 is the interest. Round off to 2 decimal. Round off to 2 decimal means what? After decimal, I have to have, after the decimal point, I have to have 2 numbers. Clear with this point? Just bear with me for next 5 minutes. You'll understand what are we trying to do. It is very logical to understand. So September 16 is the date on which the sale has taken place. 1st October is the date on which we are supposed to receive the payment. But we have presumed that on this date, the payment is not received. So from due date till the account current statement date, we calculate how much number of days there is delay in payment, and we have calculated how much interest is receivable. Guys, this 4.04 is the money that we are supposed to receive. Why? Because we have presumed that Shyam has not made the payment on the due date. In such a case, he has to pay interest. So for business, we have to receive, right? So for his interest receivable, because I have not yet received, I'll receive in future. So it is interest receivable. Any problem with this? No problem. Online people comfortable so far? Abhi, Ashwin, Chavi, Kavi, Rishabh, Rupesh, Shrikant, Saraswat. Are you comfortable with this so far?
Yes, sir.
Yes, sir.
Yes, sir.
Now, guys, on October 1, that is the due date. On October 1, cash received from Shyam. On the due date, how much money you are supposed to receive? You're supposed to receive 200, but you're receiving only 90 rupees. So what did you assume here? You assume that on the due date, entire 200 is not received. On that, you've calculated the full interest. Yes. Now, out of 200, he has given us 90. So to extent of 90 rupees, should you not reverse the interest? Think aram se. I'm telling you that when you calculated the interest of 4.4, you presume that Shyam did not make you the payment on 1st of October till the account current statement date. Therefore, on 200 rupees, we have to receive 4.04 interest, like that you calculated. But on 1st of October, out of 200, 90 rupees is paid on the due date. So on the 90 rupees, don't you think that we have to reverse the interest? So something is recorded in debit. To reduce this, I have to give a corresponding credit. Debit is plus. To reduce debit, I have to give a minus on the credit side. Correct? So what will I do is that cash received from Shyam. What is journal entry? Cash account debit to Shyam. So can I say in Shyam's ledger, by cash will come? So date is when? October 1. October 1, by cash, you're receiving how much? 90 rupees. By cash, you're receiving 90 rupees. Due date here, guys, due date will be here, the transaction date. Due date will be the transaction date. Are you able to follow? Because for payment and receipt, what will be the due date? So transaction date will become the due date. Are you able to follow, guys? Now, from October 1 to the account current statement days, can I say same 123 days? Because here already we have calculated 123 days. How did you get? From due date to account current date, you already calculated. So same here, same due date here, till account current statement days, can I say 123 days? So now calculate the interest to be reversed. So 90 into 6% into 123 divided by 365. Divide by 365. So guys, the interest is 1.82. Interest is 1.82. Interest is 1.82. So what has happened here, guys? Here you said that 4.04 rupees you have to receive. So if you see here, guys, 4.04 is the interest receivable. On 200 rupees, the interest that you are supposed to receive is 4.04, which you have debited, which means we have to receive. But from that, guys, 90 rupees is actually collected on the due date now. So to the extent of 90 rupees or on the 90 rupees, we have to reverse the interest, right? So that interest what we are supposed to receive is 1.82. 1.82 minus by crediting it. We are minusing it. Are you able to understand? So balance, can I say from 200 if I minus 90, can I say balance 110, amount is not paid on the due date? And have they given any information when the amount is paid? No. So this 110 till the statement date, it is not paid, like that it is presumed. So what is the net interest that is receivable? 4.04 minus 1.82. So this statement is drafted in such a way, guys, automatically, I'm telling you, automatically things will calculate the interest by itself. I mean, the net interest, net result will automatically get calculated by itself. Are you able to follow? So can we proceed forward? Online people, do you have any doubts? Online people, do you have any doubts?
Sir.
Next transaction, guys, on October 21, goods purchased from Sham on credit only. This is. So what is the credit purchase entry? Purchase account debit to Sham. So can I say in Sham's account, so buy purchase will come? Buy purchase. What is the transaction date? October 21. So October 21. So buy purchase. 500 is the amount. And the amount to be paid is December 21. Due date of payment is December 21. December 1, not 21, December 1. Yes. Okay. Now, guys, here the same presumption that on the due date, we are not making the payment. So from the due date till the account current statement date, we'll calculate the number of days. And for that many number of days, we'll calculate the interest payable, because here we have done, Nath brother has done the credit purchase. So on the due date, if we are not making the payment, we have to compensate by paying the interest. So this interest, what we're going to calculate is the interest payable for us. So how many days of delayed payment, guys? December has got totally 31 days. In that first day of December, if I minus, I'll get 30 days plus 31 days of January plus 1 day of February. So 62 days. So for this, what is the interest? 500 into 6% into 62 divided by 365. So this is the interest payable. Is it clear? Online people, is it clear with everyone? Now, guys.
Yes, sir.
On November 1, paid to Sham. Who's paying to Sham? Nath brothers. We are paying it to Sham. 330 rupees. What is the actual date of payment? December 1 should have been the payment date. That is the due date. But can I say the payment is made on November 1? So what is the entry, guys? What is the payment entry? What will be the journal entry for payment? Money is going out, so to cash. So Sham account debit to cash. To cash. Can I say in the case of payment or receipt of money, due date is equal to transaction date. So same entry will come. Now same date will come. November 1. November 1. Amount is 330. Amount is 330. Amount is 330. So tell me, guys, 500 rupees was the payment which is supposed to happen on December 1. And you have calculated the interest here, assuming that the payment is not made till the end, and you have calculated the interest payable. Now here, can I say out of 500 rupees, can I say 330 rupees is paid in advance? 1 month advance. Look at the timeline, guys. Look at the timeline. What is account current statement date? 1st of Feb. What is the due date of payment? 1st of December. What is the payment date? Actual payment date? 1st of November. Correct, no? First of November is the amount payment date. Now, guys, on the due date, you are supposed to pay 500. You presume that from the due date till the account current statement date, amount is not paid, and for that you have calculated an interest of 5.10. Out of this 500, guys, 300 rupees is paid, 330 rupees is paid. If I'm not wrong, 330, right? 330 is paid, and that too in advance. So first of all, can I say for this period to this period, for 330 rupees, interest needs to be reversed, because you made the payment out of 500 on the due date. You have made the payment of 330 rupees. So on the 330 rupees, you have to reverse the interest. Plus, for making early payment, you have made this 330 payment when? Not on due date. You have made the payment on actually November 1st. So for this period, for making early payment, should we not receive additional interest? So 2 interest component has to be received. So here, from November 1 to 1st Feb, please calculate the number of days. November totally we have 30 days. In that 1 day is gone, plus 31 days of December, plus 31 days of Jan, plus 1 day of February. So you're making payment 92 days. Like 92 days earlier than the account current statement date. So what is the interest here, guys? 330 into 6% into 92 divided by 365. How much rupee interest reversed? 5 rupees, guys. 5 rupees reversed. Now listen to this very carefully. Now, guys, from 1st December to 1st Feb, you had calculated interest on 500, assuming that the payment is not made. But can I say the payment is made? So from this period to this period, on 330 rupees, I have to reverse my interest. So 330 into 6 by 100. From 1st of December to 1st of Feb, how many days? 62 days. 62 divided by 365. Please tell me what is the interest that we are supposed to reverse? 3.36. 3.36 we are supposed to reverse. Not only that, with this I will add, for additional 1 month prior you are making the payment, so we have to receive interest. So on 330 rupees into 6 by 100 into 30 by 365, how much? 1.63. Correct? 1.63 plus 3.36. If you total, what will you get? 4.99. If I round off, it is 5. What is this 3.36? Can I say this is reversal of interest payable? If I want to reverse my interest payable, can I say I'll put the interest on the interest receivable side, opposite side? Because interest payable means here on the credit side, if I record the interest, it is payable. If I want to cancel something on credit, can I say I have to put it on debit? So in the debit side, I'm telling you that interest reversed on 330 rupees is how much? 3.36. Plus, with this, guys, you have made this 330 payment on 1st of November. So for making 1 month early payment, you're actually supposed to make the payment on 1st of December, but you made payment on 1st of November. So can I say 30 days earlier you made the payment? For making early payment, can I say you have to receive interest? I made the early payment. Nath brothers have made the early payment. So for that purpose, can I say we have to receive the interest? So interest receivable is how much? 1.63. Interest receivable on early payment is 1.63. Both put together is how much, guys? 4.99, which is 5. So everybody understand this statement or this format is designed in such a way you don't have to break your head. Everything will take care of it. If you follow all the transactions from its due date till the account current date, everything will automatically take care of. At the end, if you do the total, that should be well and good. That will give you first how much interest is payable and receivable, and that is the amount that you are supposed to either receive or pay to the party. That's it. That is the beauty of this statement, guys. Please tell me if you're clear or not clear with this. Online people, clear or not clear? Comfortable?
Yes, sir.
Everybody?
Yes, sir.
Yes, sir.
Now, guys, next is on December 1, paid to Sham. So on the due date, guys, again 330 rupees is paid. So December 01, again payment is made. Can I say 2 cash? 2 cash. What will be the due date? Same due date itself. Due date will be same as transaction date. So December 01. Amount is 330 again. Now, guys, you calculated that 500 rupees is not made on due date, and you calculated the interest payable on that. You assume that this 500 is not made payment on the due date. You calculated the interest payable. Out of this 500, 330 already the payment is made in advance. So what is the balance payable? 170. So you thought that this balance 170 also is not paid on due date, and therefore what did you do? This 510 minus this 499 is the interest for balance. Can I say 170 rupees, which is presumed having not been paid, but that also is being paid now. So out of 170, guys, you're making 330 payment. So this 330 payment, what you're making is one part belonging to this 170. And balance is how much? 330 minus 170 is how much? 160 is the early payment, or you can say advance payment. Guys, understand one thing. You thought that this 500 rupees will not be paid on due date. Therefore, you calculated interest payable of 5.10. After that, 330 rupees was payment made. So to this extent, you reverse 3.36. So 3.36 you reversed. Balance, what did you get? 5.10 minus 3.36. What is the balance? 1.74. 1.74 is the interest payable for balance 170 rupees, which is presumed having not been paid. But this 170 also, guys, can I say it is paid on December 1 itself? And this 330 what you're making payment, guys, this 330 what you're making the payment is the first payment of 170 rupees. In balance 160 rupees, you have paid the advance payment. So now can I say this interest needs to be reversed? And for making an advance payment of 160, for this interest needs to be recovered. Both this will come on the interest receivable side. So from December 1 to 1st of Feb, from December 1 to 1st of Feb, how many days, guys? Can I say December has got total 31 days minus 1 day of December plus 31 days of January plus 1 day of February, 62 days. So please calculate the interest. 330 into 6% into 62 divided by 365. This 3.36 is nothing but on 170 the interest component is 1.74. On 160 what is the interest component? On 160 into 6 by 100 into 62 by 365. Please tell me what is the amount. 160 into 6 by 100 into 62 by 365. 1.63. Now please add these both. 1.74 plus 1.63. Please add it. What are you getting? 1.74 plus 1.63. 3.37. 3.37. So this 3.36 or 3.37 is nothing but on this 170, the interest which is still due to be paid, that is getting reversed because this 170 also is paid on 1st of December. Not only 170 you paid, along with this 170 you paid 160 as advance payment also. You did not receive the good, but 160 you made the payment in advance. So for that you will receive the interest, right? So both put together 3.37. So 1.74 is nothing but reversal of interest payable. And this is nothing but interest receivable. Reversal of interest payable. Where do you record? On the interest receivable side, no? And interest receivable on interest receivable side. So this is how the concept is, guys. This is how the concept is. Any problem here? Abhi, Ashwin, Chavi, are you comfortable?
Yes, sir.
Kavi, Rishabh, Rupesh, Sanjay, Shrikant, Sir. If you have any doubts, just you can stop me then and then and ask me, guys. This is very simple statement. Now, if I don't explain this concept also now, you'll be able to do this. If I tell you this is the format, this is how you have to do, you can still do it. But I'm going one step ahead to make you understand, because as a CA, if you are not aware, what are you doing, for what purpose are you doing, then what is the purpose of doing such a course? So you should know the statement, how it is going to help you. That is why I'm explaining this. Now, in upcoming transaction, I'll not explain in detail. I'll be only doing the sum as per the format. But so far, what I did is I'm just trying to give you an idea how things are working. What is the conceptual or logical reason behind what we are doing? What is the impact of each and every transaction that we are recording? Are you clear with that impact? Okay. Next transaction, quickly. On December 5, goods purchased from Sham. So can I say buy purchase? On December 5. Buy purchase. Due date is how much? Jan 1. So Jan 1. So Jan 1 to 1st Feb. We have to presume that the payment is not made. Therefore, how many days are there? In Jan, totally 31 days. In Jan, totally 31 days. 31 minus 1 day of Jan plus 1 day of Feb. So 31 days. What is the amount? 500. So interest is 500 into 6% into 31 divided by 365. This is the interest payable. This is the interest payable. Clear or not clear? Next, on December 10, guys. On December 10, again, goods purchased from Sham for 200 rupees on 1st of Jan. Due date is on 1st of Jan. So December 10. Again, buy purchase. Value is 200 rupees. Due date is Jan 1. So can I say due date is Jan 1? Previous due date also Jan 1. So can I say same 31 days? So it will be 200 into 6% into 365. Sorry, into 31 divided by 365. 1.02 rupees is the interest payable. Then on Jan 1, guys, paid to Sham, 600 rupees is paid to Sham. So what is the payment entry? Sham to cash. So to cash. What is the date? What is the amount involved? 600. So here in the payment, the due date will be equal to the transaction date. Yeah. So 31 days of Jan minus 1 day plus 1 day of February. So 31 days. 600 into 6% into 31 divided by 365. 3.06% is the either interest receivable, or you can say the interest payables reversal. Yes, now are you able to understand debit part? Debit denotes two things. Either it is interest receivable or it is reversal of interest payable. Credit side means interest payable or reversal of interest receivable. Are you clear with this point?
Yes.
Everybody?
Yes, sir.
On Jan 9th, guys, goods sold to Sham for 20 rupees. Goods sold to Sham. What is the entry? Sham to sales. So this is on Jan 9th. To sales. What is the due date on which I have to receive the payment? 1st Feb. So Feb 1 to Feb 1, can I say number of days is 0? Amount is 20. So interest will be 0. Clear with this? Now all the transactions have been captured, guys. Have we captured all the transactions? Yes. So here, after recording everything, guys, the first step, what will you do is you will find out the total of the interest receivable column and the total of the interest payable column to see whose total is more. So which total is more, guys? If I do the total of the interest receivable, it is coming up to be 5.46. Sorry, 15.46. The total of interest receivable is 15.46. You can see here, 15.46. If I see the total of the interest payable, it is coming 10.48. So interest receivable is 15.46. Interest payable is 10.48. So which is bigger, guys? Can I say interest receivable is bigger? So can I say balance will come here? So on Feb 01 by interest. By balance of interest. By balance, I'm just coming. By balance of interest is how much? 15.46. 15.46 minus 10.49. So 4.97 is the interest. 4.97 is the interest. So can I say, guys, total of both debit side, that is interest receivable, and the credit side interest payable is 15.46. Now 4.97 is what, guys? It is interest receivable. It is interest receivable because interest receivable is more, interest payable is less. Because of the balancing procedure, the 4.797 is coming on the payable side. Just because 4.97 is coming on payable side, it doesn't mean that it is interest payable. It is interest receivable. Which side is more? 15 is more. Interest receivable is more. Now, if interest receivable, what is the journal entry for interest receivable? Sham account debit to interest receivable or interest income. Sham account debit. So can I say two interest will come here? So first step is you'll find the balance of interest. First step will be to find the balance of interest. I'm coming. First is you will find this interest. Then once you find the interest, first you have to post that amount in the ledger of Sham now. Because whatever the amount column is there, that amount column denotes how much money you have to pay, how much money you have to receive. So with that, will you not go and add the interest amount? So what will be the entry? Sham account debit to interest receivable. So to interest. How much? In the amount column, 4.97. 4.97. So total, how much money you are supposed to receive? 200 plus 330 plus 330 plus 600 plus 20 plus 4.97. You're supposed to receive 1,484.97. This is amount receivable. Now see what is the amount payable. Amount payable on the credit side. The credit side of the amount column denotes 1290. So debit side means this is the amount that we have to receive from Sham. So 1484.97 is the amount that I have to receive. And how much I have to pay to Sham? 1290. I have to pay on the credit side amount total. If you see, it is 1290. So if you do the total of debit side, guys, I'm getting 14. 84.97. This is the amount that is receivable. This is amount receivable from Sham. And on credit side, you're getting 1290. 1290. This is amount payable to Sham. So you have to do the balancing. So in net, if I take the difference, who will pay to whom or who will receive from whom? Can I say debit side is more? So what will be the difference? So 1484.97 minus 1290. Difference will be the amount receivable from Sham. Correct, no? I have to receive more and I have to pay less. I have to receive more and pay less. So net he has to pay me. That is, I have to receive how much the difference?
194.97, sir.
194.97. This is the balance carried down. On Feb 1, by balance carried down. This is how we close the ledger, no? Balance carried down. What is the amount? Sum total of the debit minus the sum total of the credit. 194.97. That's all, guys. We are done. Nothing will come. Why will anything come on the which transaction date? You interest at all telling? Okay, interest you write Feb 1. Feb 01 is the date on the transaction. Yes. You can split here and it is 2020. Yes, the year is very important. So after December, it is 2020. Here also 2020 will come into picture. Any difficulties, please? So just imagine, instead of doing this, if you do a normal ledger, so one credit purchase, credit sale will be in one Sham's ledger. How much interest paid, payable, separate ledger, interest receivable, separate ledger. Then I have to put all the three together to see who has to pay what. 3 ledgers, headache. So all the three. So this is account current is nothing but, guys, the compressing of all the 3 ledger into one place. So guys, please understand this. Amount column is there now. This amount column in debit, amount column in credit is nothing but your creditor and debtors account. Interest receivable is asset account, interest payable is liability account. So those 3 ledgers what we discussed now, we have put together in one place in form of account current. That's it, guys. That's it. So that in case where there are numerous transactions happening between the buyer and seller, which is also involving the concept of interest for delayed and early payment, that is being calculated in such a way that it will not be a painful or a burdenful job. It becomes very smooth. So concept goes very simple. Whatever due date you are calculating, from the due date till the account current statement date, calculate that many number of days and calculate the interest. Automatically, the system is designed in such a way that your interest gets automatically adjusted. If you have calculated the excess interest, upon making the payment on time, the interest is automatically reversed. If you're making early payment, automatically the interest on that component is being calculated. So this design is being done in such a way that you don't have to actually brainstorm too much. If you follow this format strictly, at the end, the interest what you get is the right interest or the same interest you will get it had you done this separately in different ledger. So do a couple of more questions based on this, guys. We'll do more questions based on this. Automatically you'll get a clarity. So from here on, we'll be strictly following the format. So format following and doing the question is no big deal. What is important is to understand what is the impact for each transaction. That is something which I want to convey through this example. So please tell me if that is conveyed or not conveyed. Everyone. Online people, I'm not getting responses.
Yes, sir.
Conveyed, sir.
Everybody is able to understand the concept, no? Logically?
Yes, sir.
Yes, sir.
Fantastic. So with that, I put to end for today's session, guys. Tomorrow we'll be meeting with the, we'll be discussing the same chapter and we'll be doing the next method under the forward method, which is the product method, right? So today we have learned how to calculate the interest or account current statement under the forward method. And in that, the method what we followed is the interest method, right? So yes, people. Online people, do you have any doubts?
No, sir.
No, sir.
No, that I'll discuss tomorrow. Right? Same format. Just instead of interest column, it will be product column. That's it. CS people. It's very easy chapter. Nothing to worry about. CS people, that's all from my end for today's session. I'll see you all in the next class. Until then, bye-bye. See you. Take care.
Thank you, sir.